What's up, Radar Gang? Welcome to another Market Radar podcast. Hope you've had a great week. It's been a very eventful week. We had FOMC on Wednesday, and that's really what kicked off the movement this week in both the NASDAQ and bonds. NASDAQ is now reaching Momo. Happened fairly quickly. This stuff really comes at you quick. And now we are at the point where NASDAQ needs to hold on to its bullish trend. If we can stay up here above Momo, get a nice bounce off, this is a good time if anyone's looking for dip buys. Dip buying at Momo is the ideal time because you can use that bearish trend reversal as your stop loss. So that's the ideal risk to reward that you can get. But obviously, we trade based off our system along with DDAP. They both have to line up. So if you're a member, you'll know where we stand on all this and what our trades are. But at the end of the day, it's bullish trend. We do not short bullish trends, but now we are at that point where the NASDAQ needs to hold on and fight for that bullish trend. Let's take a look at bonds. So bonds, the day after FOMC really collapsed. We are well into new lows on ZB. So what do you think, Gamma? Are we still going to see bonds move further down? So we're seeing this happening now. We're seeing rate cuts being further pushed out on the curve, on the EFFR futures curve. And at what point does this stop? At what point are we going to stop seeing bonds move lower?
So the most important thing when you're looking at the bond space is going to be, especially the long end of the yield curve, is going to be the whole prospective idea of a recession, right? And specifically how it's going to play out. So the idea that the recession is imminent would lead the market to have some sort of artificial bid in bonds, preventing yields from really going higher because everyone's like, okay, the recession's almost here. We'll just buy bonds, get ahead of the curve. It's almost we're almost there, sort of thing, right? But as that recession the recession fears get removed from the market, currently we have the short end of the yield curve, the Fed funds rate, pretty much, right, all the way up at 500 basis points, and the long end is 4.5% and below, right? So we have this whole inversion in the yield curve, that the reason being is because everyone's like, okay, on the long end, rates won't be this high for that long. There'll be a recession between now and then. There's this discount, right? That's why yield curve inversions happen, because there's this idea that short-term interest rates are in an imbalance towards the longer-term trend, and it's typically something that's corrected by, I should say, a recession.
So
So,
what happened during this FOMC that caused this move in bonds? So I
right.
know Powell was very hawkish. This was a very hawkish pause. But what exactly did he say that really caused this move that we saw here?
So basically, Powell was pretty stiff on the idea that they're not going to cut interest rates anytime soon. They made that very clear. And he also made it very clear that there is a good chance that the Fed will raise interest rates at least one more time in by the end of the year, right? In the next two over the next two meetings. So the market obviously took that as very hawkish, and so did both the bond and stock market. And the idea is this, right? If there's no recession around the corner, you have to start basically reverting what I just said earlier. And we'll talk about the yield curve reversion, or inversion, I should say, and how that reversion would take place, basically coming back into balance in a few minutes. But let's talk about why the long end went up and long bonds went down. So let's just take a quick look here at the Fed funds futures. This is a screen. Understand, this is an old screenshot, right? This is before the Fed had their meeting. So this is from last week. And then we're going to look at one from this week. But what you'll notice here is the implied policy rate by next July was around 5%, a little under, or at around 5%, right? And there was an expected cumulative rate cut number of a little over one rate cut, meaning the market was pricing in the odds of at least one rate cut by next July, at least one, right? and the Fed funds rate being dropped to 5%. Well, after the FOMC meeting and Powell's press release and all the commentary that followed, the curve has changed just slightly, right? So now the July expectation, the implied policy, is no longer 5%, but a little over 5.1%. And that one and change rate cut that was sitting in the market, in the totality of the data going out to July, right? In total, the market was pricing in one rate cut by next July. That is now actually less than one, meaning the market's not even confident any longer that we're going to get a one total rate cut by next July. So things have changed. The market's obviously, as you mentioned earlier in the podcast, pricing out the recession by pushing out the rate cuts. And when this happens, what's going on really, simply put, is the market's trying to normalize at higher interest rates, because if there's no recession, there's no reason for the Fed to cut interest rates, because obviously the Fed is, if the labor market's still tight and strong, there's no reason for the Fed to cut interest rates, and inflation's coming down. Powell made it very clear as well that growth isn't really part of their policy narrative. And we've said this before, right? Like, growth isn't going to really drive the Fed. Just because growth's hot, the Fed isn't going to actually automatically be hotter than they should be, right? They're going to look at the whole picture and they're going to say, okay, if growth is hot, will it affect inflation? And if it starts to affect inflation, then they will go ahead and adjust policy. But just because growth is hot doesn't mean the Fed is going to have to just continuously hike until something is breaking. Like, that's not how this works. And Powell made that very clear. So he also made it very clear that they're in a restrictive state at the current point. Something can change, and the market's going to think or start to price in the idea that we're in a new level of neutral. Another thing Powell said, he basically illustrated to everyone that this neutral rate and the current neutral rate and the long-term neutral rate are not the same. They could be dislocated. Simply put, short term, because of all the imbalances in the labor market and whatnot, we could have a higher neutral rate, meaning a rate at which the economy is not expanding nor contracting. So think of that like the zero mark, where the Fed isn't over tightening or under tightening. And that could be much higher short term than it is in the long run. And this is something the market did not like, because what that's basically implying is the Federal Reserve will have to hold interest rates at a higher than expected, or I should say at a higher rate for a longer than expected period. And that's why we're starting to see these rate cuts getting pulled from the curve, bonds going down, because this whole idea is, well, if the neutral rate's higher, then long bonds shouldn't be this discounted to the curve. And we'll talk about that.
Does that also imply that we would have a higher than 2% inflation rate for a longer period of time?
Inflation may not be higher than expected going forward, but it obviously it's going to be stickier than expected, right? As we have been saying it will be. And the Fed will have to be in a more restrictive state, meaning just at a higher rate for a lot longer than most people anticipate at the current point. And that's what the Fed was trying to basically allude to everyone. The whole point the bond market's inverted is this idea that the recession will come in a short amount of time. The Fed will cut interest rates on the front end, and most likely the Fed will cut interest rates by a margin that would cover this spread. So typically, and this is where the compound lending is very unique to this environment. So typically, this yield curve spread will go up to zero and revert, and that will be the signal of the recession. And that's where likely we will get the recession this time as well. But what's unique about this time is the economy is so resilient that the yield curve will revert in a different manner, right? Instead of going up with what's called a bull steepener, what a bull steepener basically means is the front end. The reason this spread is reverting, the 10-year minus the 2-year, is because the Fed is reducing the front end interest rates. Because why this is negative is the long end rates are more negative than the front end rates, right? Or they're lower than the front end rates. So if the Fed reduces the front end rates, or the Fed funds rate, they basically rebalance this spread, this differential, right? And that's what the bull steepener looks like. That's what a bull steepener is, right? But the whole point here is, well, if the Fed has to stay higher for longer and there's no recession, the economy is resilient, why are longer term yields so discounted to this new higher interest rate environment if there is no recession. And this is the whole stage three of the compound landing. And as you can see here, the bond market is not stupid. It's been seeing this for a while now. Bearish trend. This looks like a sea of blood right here. This is not something I would long. I would be long. There's no point in doing that. It's just you're straight up trying to catch a falling knife and you're pretty much getting cut at almost every turn here. So that's why
Right.
bonds
So
are going down.
what we're going to be seeing is this twos and tens yield curve reverting, but reverting for the soft landing reasons.
Right. And
And
eventually it will cause, eventually the idea is that, so for this yield curve to revert through the soft landing reasons, you have to have what's a bear steepener. And we have this yield curve analyzer on TradingView. It's a free indicator. You can pull it up and you got it to your chart. And what it does is it simply illustrates the structure of the curve and the movements over the last, call it a couple of weeks and how they've been playing out, right? So the red bars indicate a bear steepener on the top or a bear flattener on the bottom if they're on the bottom, and the greens indicate bull on the top and bull steepener on the top and bull flattener if they're negative, right? So what this is showing you is the composition of the move across this spread over the last in a short time frame, right? So what you'll notice here is the yield curve had ever since it lifted off in July, it's been pretty much a bear steepening, right? And what that basically means is the back end has been lifting. The longer end yields have been lifting much more than the front end. So basically, long end yields are the reason are rising are the reason this yield curve is reverting. That's not what you see when a recession happens. It's the complete opposite. It's the green. You want to see a lot of green bars for a recession,
right.
but
So
you're seeing red.
so those people that are looking at this yield curve reverting, they need to realize that it's the type of reversion that matters as well. And I think a lot of people are going to be confused by that. So it's important to look at this yield curve analyzer right now and see if we're getting that bear steepener reversion, it's not the recession kind of reversion.
Right.
We need the bull steepener reversion, which eventually it will turn into.
Right. And some quick context. SVB was straight bull steepener. Straight. That was the idea. Okay, this would cause the recession, right? You could just say green, 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 green,
Right.
just
And
solid
in
green.
that period, we saw all these deflationary signs
Right.
throughout the market. So that's the real recession indicator when we're getting that reversion with a bull steepener.
Right. And we're just not getting that yet. So it's not something I would harp on at the moment. And I think that the yield spread could go higher. Now, the question is this, right? A lot of people are asking, well, maybe stage three is the final stage, right? This is the idea. Stage three, this normalization phase where longer end rates can climb above the front end rates, revert the yield curve, and basically just coast off into the sunset until there's another recession and the Fed can manage it there. And the idea is that maybe we have found a newer, higher neutral interest rate, and we don't need to cut interest rates at all at any point. And the argument there is, yeah, that is always a possibility. Just like a soft landing is possible, it's definitely not probable in our books. We don't think soft landings are going to play out, specifically due to the Fed. But we'll talk about that in a second. But yeah, long story short, yes, that can happen where long end can come up and actually we don't get the recession. The problem with this is everyone's basically betting in this environment where normalization, where the economy can relentlessly handle higher and higher and higher interest rates with no consequence. And I mean, we can just look at something like housing, right? The housing generation is basically built off of low interest rates. This idea that you can, like, the only reason $1 million homes, or at least a lot of $1 million plus homes, are very easily attained in such a low interest rate environment is because the amortization period and the amount of money that you have to pay in interest over the life of the 30-year loan is not a lot. It's not adding a lot to that $1 million home. But when interest rates double or triple off the lows, right, things get very ugly very quickly. And the idea of that is this economy wouldn't be able to sustain that same type of home value growth. And home values and housing is very important in an economy, right? Because that's just the consumer's end product is their house, right? Every month they're making money to pay their mortgage, in and out, however it goes. Don't if home prices can sustain a rate move like this, and basically home demand, which obviously we've seen that's already been slowing for some time now. So it's obvious that the economy can't handle this type of tightness for a prolonged period. But the problem here is not that knowing that we can't do it. It's the idea that people will need to believe that it can be done. And that's what the bear steepener is. That's that long end interest rate going up. Now, it's not so much inflationary. It's just this idea that, okay, well, if the current rates are more neutral than they are restrictive, and we're not really going to slow this economy down drastically, but we're going to basically put the air brakes on it, right? We're not going to like, it's not going to crash into a wall. Then there's enough time there for that long end to lift up and kind of rise and normalize and the economy to function properly. And it's not so much inflationary, it's just normalization. But that's not really how this works, because what ends up happening is as you normalize, there's already immense pressure in the economy. And as you normalize, you're just adding more and more pressure, right? And a lot of other factors here are driving the long end of the curve. Like you have issuances coming, right? Like now you have more targeted issuances across the duration side of the yield curve, which there's not the same amount of liquidity. If you think about liquidity in the bond market, most of the liquidity is going to be on the front end. The back end has a lot less liquidity. I'm not saying it's no liquidity, but when you're talking about targeted durations on the back end, they're more influential on interest rates than the durations on the front end, because there's more money in money markets than there's more people that will take less risk than there are people that will take more risk, right? So people are going to focus, or there's going to be a lot of demand for that short-term risk-free zero duration asset than there is for these longer term where there's more of a gamble, right? If inflation is much higher than 4.5% 10 years from now, well, your long bond is not a good buy, right? 4.5. So there's more risk there, obviously. So
Right.
the targeted duration is obviously a big deal here, which is why we're seeing rates go up, and this idea that the Fed isn't going to cut interest rates anytime soon. So that's something we got to watch for, obviously, going forward. So watch out for the bear steepener. Put the curve analyzer on your charts. You can take a look. Obviously, a lot of the last month and a half has been dominated by mostly bear steepener moves. And if it was bull steepener, it was rather split between bull and bear steepener. It got a couple of days of bull steepening in there, but that was when the yield curve was not actually going anywhere. All these up moves, any serious up move here was pretty much done via bear steepener. So watch that as we go forward. But let's wrap up this podcast with ES and RTY. Artie, do you want to say some
Yeah,
things about this?
so ES, we finally got a break below Momo. Remember, you got to look at contract roll adjusted. We are still above Momo if you do not adjust for contract rolls, but DDAP works best when adjusted for contract rolls. That's the true value. And yeah, we are still a bullish trend, but now it's time for ES to fight for it. Let's see if we get a bounce here. NASDAQ is still above Momo, so that'll be providing some resistance for going further lower. But the Russell, small caps leading on the way down. Typically, small caps do lead the larger caps, and that's what we're seeing. We've actually never gotten that full reversal from the Russell. It's always been lagging behind, and we might be seeing those effects come into play now. And now that the Russell is nearing its lows again, we might actually start seeing that pressure building on the NASDAQ and the S&P as well. So keep an eye out for that. Watch out for the regimes. Remember what regime we're in and play accordingly.
All right. Thank you guys so much for listening. If you have any questions, feel free to reach out to us on Twitter at the Market Radar, or you can go to our website at market-radar.com.